Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us about the U.S. markets again hitting record highs, what could be a first-phase trade agreement between the U.S. and China, and how precious metals are doing. Trends Journal publisher Gerald Celente gives us the heads up on whether the U.S. will be hit by a recession next year, who he thinks will be elected president in 2020, and the long-range outlook for gold and silver. WolfStreet.com publisher Wolf Richter talks to us from San Francisco. He's concerned people taking out subprime loans are defaulting on their first payments. He also talks about the tough times hitting the auto industry around the planet. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and from Cypress Development's Don Mosher. We'll talk to Ross Clark right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYP.V, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Good to be with you, Jim.
Well, we have the U.S. claiming it's got phase one of its trade deal with China done, which means no new tariffs and tariffs won't be going up. What's the reaction from the Chinese to this announcement?
Well, the Chinese on Friday didn't have much to say about it. Until the document is signed by both parties, I guess it's still up in the air, and sort of reminiscent of what happened last spring when, they getting into that business of translating from English to Chinese, ended up with a few little nuances they didn't care for. This one's probably closer. They are talking about maybe taking 2 weeks to get the paperwork done, get some signatures in early January, and then bring the full plan into place by the end of January. And as they're saying right at the end of the week, phase two negotiations are already in process. But don't hold your breath on that. May or may not see it by the time that we get to the U.S. election next November. So, on Thursday, it became apparent that there was going to be an announcement. Market rallied to all-time highs on most of the indices. Pretty good day on the upside. But the details that came out on Friday, which are still reasonably sparse, there's nothing there that's shockingly good. Everything is pretty much as anticipated, but absolutely no better than. So Friday was a day where the markets were just biding their time, and volumes for the last 2 weeks have just been exceptionally low. So even though we've had this rally, there's not a lot of strength behind it as of yet. So we're in the seasonally favorable period, takes us into the early part of January. Wouldn't be at all surprised if there's a little hiccup between here and Christmas, and you want to take advantage of that if it happens, as far as the equity markets are concerned. And some of the most beaten down areas, like energy, have been coming back extremely well. I mean, it's for all that you're getting headline news for all-time highs in some stocks. The ones that are coming off the bottoms are making the biggest percentage gains, and that's where the real money is made. It's in the buying, not in the selling.
Gold, any reaction to any of this?
Initially, early in the week, it did have a momentary run up to 1490, which is a pretty important resistance level for us, both in terms of moving average and where the last rally petered out. Closed off the week in the 1480 bracket. Seasonally, we are at that point where this thing can come to life. So closing through 1490 would definitely be a catalyst to get it on the go. When you look at the precious metals, the silver market is really the one that attracts our attention right here. because that rally we had from an April-May low into the summer, actually right into the end of September, we were looking for the exhaustion highs, the big overbought highs then, to be followed by a sharp correction where we would give back 50 to 60%, most probably around 61% of that rally, test long-term moving average at the, which would in this case be the 20-month moving average, nice and long-term, because the upside style of move that we had seen into September produced signals that we'd only seen half a dozen times in the last 30 years. And each one of those had a sharp correction like this one has become before it came to life again. And with the movement in this last week and a half, we had put in a support at about 1660, had a bounce, and then in the last few days we took that support out for the sake of 10 cents or so and reversed from there. And that kind of a spring, as we call it, is very, very common at bottoms in silver. They like to just take out the last of the week longs before the rally gets going. And from a seasonal perspective, we look back the last 30 years, 25 of those years saw a good, important low in silver in November or December. And from there, we had highs in January, February in the 24 years. So this is a window here that you want to be definitely weighted to the long side, take advantage of spurts on the upside. And most of those highs, say, are in Jan, Feb. I think there were 4 of them when we looked at them that extended then out past March. And those are some of the big ones like we had in 2011, the last time we were at $50. So, I don't think you want to play for that. You want to play for maybe a 15 to 17% move off the bottom, somewhere in the $18.50 to maybe just shy of $19 as far as silver concerned. That would be a nice run, and clearly something that you want to take advantage of if you're a trader. And if silver's going to make that kind of a move, the major silver stocks are percentage-wise going to probably do much better than that.
The U.S. dollar, is it going to continue to advance, and has the Canadian dollar done remarkably well against the U.S. dollar considering the price of crude?
Well, it's you'd think that the Canadian would have done better than this. I mean, we are stuck still here in this trading range. We're in the absolute middle of the range of the whole year as far as the Canadian is concerned. And we're up a cent off the lows of November. You've got crude oil doing exceptionally well. You've got the commodities as a whole doing quite well. You look at like a Deutsche Bank agricultural ETF, that had its highest week this week since back in July. So, what's with the Canadian? The Canadian is poor. So that means that there's, underlying issues here as far as the Canadian dollar is concerned. And as far as the U.S. is concerned, that's been in a broad upward channel for the last year and a half. And I think it was the 5th time this week it got down to test the 50-week moving average. Think of it as a 200-day moving average. That's a pretty critical support area for the dollar index, and it needs to hold that. I think if it reversed higher on Friday, but if it were to go down and take out that Thursday low, that would be a pretty major sell signal as far as the U.S. dollar is concerned. And if the dollar is going to go down, most commodities priced in U.S. dollars are going to go up.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Gerald Celente, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Gerald Celente, publisher of the Trends Journal, available online at trendsjournal.com. He's speaking to us from historic Kingston, New York. It's great to have you back on This Week in Money, Gerald.
Well, thank you, Jim.
Gerald, what are the big trends you're following for the new year?
Well, there are a lot of them. One of them is who's going to win the 2020 election here in the United States, and we're forecasting it's going to be Trump by default, and it's the fault of the Democrats. They don't have a candidate that's going to beat him in the swing states. If it's Bernie Sanders or Elizabeth Warren, no way they're going to win the swing states. And if it's Joe Biden, there's going to be a lot of dirt coming out on this whole impeachment process about what it's really about, in the sense that he got his boy Hunter a job over there in sitting on the board of directors of Burisma Energy in Ukraine, as the United States helped overthrow the Ukrainian government in 2014. And this Hunter knows nothing about energy, never been to Ukraine, can't speak the language. How did he get on the board? Along with John Kerry, who was Secretary of the State at the time, and his stepson-in-law, Chris Hines, of the Hines 57 Varieties. His partner also got on the board of directors of Burisma Energy. So this is going to be a lot of dirt for Biden, and it's going to really hurt him, and he's not that strong already. So as we're looking at it now, and of course there are always the wild cards, and there's no wilder card than the Trump card, that it looks like Trump 2020.
What are your thoughts on the stock markets for the beginning of the new decade?
They're going to keep going, we believe, because they're going to keep pumping more and more cheap money into the system. And as long as the money stays cheap, the stock markets stay up, so the gamblers could get their fix. And that's what's going on. You look at the repo markets, the overnight lending markets. The Federal Reserve of the United States and the Bank of New York have dumped in since September 17th of this year over $3 trillion. It's probably up to almost $4 trillion by now as we're speaking. So they're just going to keep pumping in this cheap money to keep the equity markets going. They're overvalued. The price earnings ratios, there should be around 16.8. And they're about 25, 26. So they're very overvalued, and they're going to keep moving up, minus a black swan event. Nobody can predict the future. You know, there are wild cards, as I said, whether they're man-made or made by nature. So there's a lot of wild cards out there, but we believe that the markets are near their peak.
Gold and silver seem to be in a trading range once again. What's needed for gold and silver to boost from their latest highs?
The markets have to go down. And the markets, when the markets with all of this repo money got repumped into it, that's when gold started to go down. When the markets were weakening back in August, you saw gold getting stronger. So that's all it's about. It's because gold is a safe haven asset. So the gamblers, when they see there's danger on the Wall Street and the other equity markets, they go into safe havens. Right now, there's not a safe haven fear, and that's what's keeping gold prices moderate as they are.
Do you think that recession could be just around the corner in the U.S.?
No, we don't see it coming around the corner in the U.S. What we do see is more cheap money flowing into the system with lower interest rates. And the same thing with Canada. They have room to lower interest rates a bit more. So we're going to see in 2020 more central banks lowering interest rates, and we're forecasting that by this time next year, you'll see interest rates in the United States to zero or even negative policy.
How will negative interest rates work out for the U.S.? It doesn't seem to have done anything for the European economy.
Well, it had for a while, and the United States has, again, what it does is it artificially juices the markets. Look at mergers and acquisitions. They're skyrocketing again because of the cheap money and the corporate debt, the cheap money. So temporarily it'll work. But as you point out, it's not working any longer in Europe, so what they're coming out with is fiscal stimulus. So that means taxing people more so the government could create more jobs, infrastructure development, or whatever they want to call it. And that will, again, boost the economy, but only short term, and that's what Japan is doing right now. They just announced it last week, and they're pushing more and more infrastructure money into the economy, building bridges to nowhere and wasting money in a short-term attempt to reboost their economy.
Negative interest rates certainly, I don't think, would help pension plans in the U.S., would they?
They're hurting everybody. Matter of fact, in Germany, there's a big protest about it because it hurts the savers. It hurts the average person. Once upon a time, people used to have a thing called, savings accounts, and they put money in the bank, and they got a return on their savings. And CDs back in the day, you get a nice return on your savings, and that helped the average person. But again, the cheap money, what they're interested in most is boosting the global economy. Boosting the multinationals, and that's where the money's going, to the gamblers and the multinationals that are buying up more and more companies and putting everybody else out of business.
Now, seniors who might be affected most by zero or negative interest rates, do you expect them to come rolling down in hordes in their wheelchairs to get the attention of politicians and perhaps boost rates again?
Not at all. There's very little fight left in the Western nations, particularly in America. And so, no, they just take it. What can we do? What can we do? I hear it all the time. What can we do? And when you look around the world and all the protests going on, whether it's Hong Kong, Lebanon, Chile, Ecuador, Bolivia, Colombia.
France had 800,000 people in the street last weekend.
Different. That's what I said. It's different. Well, all the ones I just mentioned, mostly young people.
Yeah.
But France is different. Everybody gets out to the streets there. So it's a different mentality. There's no fight in America. Look what's going on in Hong Kong. I mean, this began in June, and it's still going on. Look what's going on in Algeria. 40 weeks the people have been taken to the streets. They keep going out. In America, you're lucky to get 1 million people out. Hong Kong, where they have 7.5 million people around there, and they get 2 million people out to the streets. Out of 325 million in the United States, you're lucky to get 1 million out on Pink Pussy Day, one day, and then they go back home. Now you don't have a fight in America, and you don't have it in Canada as we see it either.
The U.S. dollar appears to be in a trading range. Is it more likely to move higher or lower in the new year?
It depends on what they do with interest rates. So if they keep lowering interest rates, the dollar will get weaker. But where the dollar is now compared to the other problems the other countries are having, the dollar will remain where it is now.
Oil and the Middle East, is there a trend there to see?
Yeah, the big trend, of course, is Saudi Arabia taking Aramco public, and they didn't get the money that they thought they would, but the Saudi people are buying, the Saudi government are buying up more of their stock. And now we're seeing oil prices move up a little higher because the OPEC and its other outside members agreed last week to cut back another 500 barrels of oil a day. So now they're holding back about 1.7 million barrels a day because there's too much supply and not enough demand. So I would forecast that oil prices where they are now in Brent crude, around $64, $63 a barrel is what you'll see. However, if tensions keep escalating in the Middle East, particularly against Iran, and you see oil prices could then spike to well over $100 a barrel. And if that kind of thing happens, that'll bring down the global equity markets and the global economy.
We're seeing riots in Iran as well. What does that mean? Is that regime going to be able to continue with their particular agenda?
Yes, because what they're doing is the riots are happening because of economic warfare launched by the United States. They did the same thing down in Venezuela. Go back to the beginning of the year. Remember, all the American press was saying that Maduro in Venezuela was going to get overthrown by this guy Guaido, who declared himself the president of Venezuela. Now, Guaido's gone. Basically, nobody heard of him anymore. Maduro's regained a lot of his strength, and it's going to be the same in Iran. I mean, yeah, the people are protesting, and they're angry about what's happening, but they also know why it's happening. And the reason why it's happening is because of the economic warfare. And this mentality that you're going to keep driving countries into poverty and have the people revolt against the leadership so that you could put in regime change is really sick thinking by the Western nations and others that do it.
Is there a power play in Washington over interest rates?
Yeah, the power play is the president, and it's been going on before Trump. Go back to Richard Nixon when he called in Burns and told him to lower interest rates as inflation was going up right before the election, and Burns did. Paul Volcker just passed away. He wanted to get his new book out before he died. And in his new book, he told about how he was called into the White House by the Chief of Staff, James Baker. He sat in the library with Ronald Reagan. Reagan didn't say a word. And James Baker said to Volcker, "You have orders from the president not to raise interest rates before Election Day." And they didn't raise interest rates. So yeah, the president has the power, regardless of what people say about the central bank having, being independent. And it's not independent. These are banksters. I mean, you don't get to, by the way, you don't get to be where you get to be a chairman of the central bank or any of these things without sucking your way up to the top. So these are tough people. They do what they're told at the end of the day.
President Trump signed an executive order backing democracy in Hong Kong. Both houses of Congress also supported that bill. Was this a good move on the part of the U.S.?
Well, Trump knows what he did. The bill was going to pass without Trump. So the White House, as we wrote now at Trends Journal magazine, they contacted China and said, listen, this isn't going to make any difference. We can't stop this, so we're going to sign it so the president doesn't look weak and bad on this, but it's not going to change anything. And as you can see, it hasn't changed anything because the equity markets on Thursday in the United States hit a new high on the note that trade deals getting close with Trump and China. So it's just a lot of propaganda and BS. It doesn't mean anything.
Will the Chinese tanks roll in Hong Kong eventually?
I believe they may not be tanks, but I believe they're going to crack down on it as it gets more and more out of hand. What's stopping it is that Hong Kong is Asia's financial capital, and China doesn't want to risk that. But they're not going to let this autonomy movement escalate, and they're going to bring it down at some point at the right time for them.
We'll have more with Gerald Celente when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Gerald Celente. Gerald, are the Republicans likely to sweep the House, the Senate, and the White House in November?
Oh, no. It's up in the air. It's very hard to call who's going to win and control either house at this point. It depends on a lot. But again, on the grander scale of the election, we believe Trump is going to win again.
Will anything get done by the government? It seems if you have a Democratic president, the House is on the opposite side. Nothing really seems to get done. And then if you have a Republican president, a Democratic House of Representatives, and it seems that things get stalled. Is the U.S. government in a permanent state of being stalled?
It's been in a permanent state of being stalled for just about all my life. They only pass what they want to pass, and if it suits both of them, they do it. Look at the defense budget. They just passed in the House almost unanimously a defense budget that, is hit new highs. So when it suits them, they do what they want. But the little issues they fight about. But the big ones that the lobbyists tell them what to do, they do.
Is the New World Order meeting resistance?
The New World Order is meeting big resistance. That's why you see what's going on around the globe. As I mentioned, take a trip, start at Chile, go up to Ecuador, Colombia, Peru, Bolivia, Argentina, Lebanon, France, Spain, Hong Kong, Algeria, Cameroon, Sudan, South Africa, Zimbabwe. All around the world, people are uprising against the New World Order. Now we call it, the new trend is the New World Disorder. They're fighting against the big. They're fighting against globalism. They're fighting against the multinationals owning everything and people just being plantation workers on the multinational plantation of Slavelandia. When people lose everything and have nothing left to lose, they lose it, as I say. And that's what you're seeing, that people have nothing to lose. We're going to have an immigration problem that's way beyond what anybody's going to be able to deal with. As the global economy slow down, as violence, corruption, crime, and poverty escalates in all these nations, people are going to do everything they can to escape. And we're not preparing for it. And also the homeless problem is going to be, in a country, state, city, town, and village near you.
Is there any solution in North America to homelessness?
I have a solution. And I just mentioned about the defense budget. Let's cut that defense budget and take several $billions, and we have all this beautiful land in America. I'm up here in Colonial Kingston, New York, the foothills of the Catskill Mountains. This place was known at one time around here as the Borscht Belt, back in the day when you had the Rodney Dangerfields and the other comedians and singers that used to perform at the hotels in the Borscht Belt, Grossingers and all the big ones over there. These places are all dilapidated, burned down. They're gone. They're gone. But there's this beautiful land up there, and all the beautiful state land and federal land. Why not build facilities to put the homeless there? I mean, in the summertime, people die to go up to these places and camp. So now you're putting people in beautiful areas. They could garden in the summer. They could do other kinds of work all year long, rather than the stupidity of the politicians putting them in homeless shelters in the middle of cities that are very expensive, and they're locked into a tiny little joint. So that's a partial solution for it. So to give them some dignity, putting them in places where they can have respect, and also help give them a future by having them do things that are going to be able to use their skills and grow with.
Is socialism being pushed in the U.S. and around the world by using the climate change narrative?
And there's no socialism. I mean, the climate change thing, I say to people, what are you worried about climate change? You're going to be dead before that happens because they're poisoning us in a million different ways. All the poisons, the pesticides they put in our food and our earth and the air. Look what's going on in India with the air pollution. It's like, 40 times, 400 times worse than at dangerous levels. So, I mean, you talk about climate change. I mean, this is ridiculous. How about changing things right now before we die? But they're not doing that. I mean, now they just came out with a study, that hair dye that you're using, what the cancer that it's causing on people, particularly women, and black women the most, according to the study. So, I mean, climate change, what's socialism? There's no socialism. It's fascism. It's the government taking over control with the corporations in hand. It's the merger of state and corporate powers that Mussolini called fascism.
Are people aware of the downsides to socialism?
Well, of course not, because what's the upside of what they used to call, we don't have capitalism anymore. In capitalism, there's no such thing as too big to fail. I mean, look at the inequality. You talk about the repo markets, the trillions of dollars being pumped in there. We talk about the mergers and acquisitions. The big companies borrow money for nothing. Wait, you borrow in the repo market at 1.5% overnight? But if you have a payday loan, what do you get in Utah, 650%? How about your credit cards? What do you get, 17, 20%? This isn't capitalism. What downside is socialism? Right? The downside of this is fascism. It's corporatism. So, yeah, people will go to a new way because they're getting nothing. And again, when people have nothing to lose, they lose it.
Mm-hmm. Is the deep state swamp starting to get exposed for their crimes?
Yes and no. They came out with a big study a couple of days ago showing the fraud, the lies, the deception of the Afghan war. It made it in the news partially one day. The next day it was gone. People don't care enough.
Didn't the same thing happen with the Vietnam War? The government really didn't believe they had any chance of winning it for 20 years?
Yeah, but they lied. Oh, if we had more power, then we could have get it there. They held back on a gun. They didn't let us kill more. We only killed 3 million people over there. If we killed 23 million, then we could have wiped out the whole country. I mean, that's the sickness of the people that are doing this stuff. And there's no protest about it. Again, the Afghan war, the longest war in American history, by far. And it goes on. People don't know anything about it, don't know why it started, don't have a clue, and they don't care.
In Canada, Prime Minister Justin Trudeau was re-elected with a minority government, but members of the opposition wiped him out in Alberta and Saskatchewan, and it's given birth to a new Wexit party for the separation of Western Canada, British Columbia, Alberta, Saskatchewan, and Manitoba. Do you see this plan having any success?
I don't know enough about it, but it's something that I believe that if it's done properly, you'll have more and more people supporting it. Remember, Quebec almost left a long time ago. They got very close to it.
1% away in a referendum.
There you go.
It looks like BC and probably the rest of Canada are heading for a real estate recession. How bad can real estate recessions get, and are all recessions real estate recessions?
We have we came out with our top trends for 2020, and one of them is real estate peak. It's all going down from here. How low it will go depends on where you are and how high it went up. But there's a slowdown in New York, all over. I mean, New York City. It's a whole different trip right now. So it's going to keep going down. But as they lower interest rates, which they're going to do again in Canada as well, it'll artificially prop them up for a short time.
Mm-hmm. Are the 2020s going to be roaring like the 1920s?
In many ways, yes. In the sense, not in the equity market level, but people are really down and they want to get higher, and beyond the cannabis, of course. And they're looking for entertainment. They're looking for what can bring their spirits up. They're ready to have a good time. This can be the roaring 2020s in entertainment and other fields that the smart entrepreneurs see and understand. It's not going to come from the establishment of the entertainment business, Hollywood or anywhere, Disney World or any of that other kind of thinking from them. It has to come from the roots up. People know how bad it is. They want their spirits lifted, and this will be a good time to do that for the people that understand what the people are looking for.
We have so many new streaming services coming on. Can they all survive? You can only watch so much boob tube in a day.
No, they're not going to. They're going to be a big merger and acquisition of many of them. The small ones will go out of business. These are short-term movements. It always happens when something new gets very big. A lot of people get into it, and then only the strong survive.
Fukushima happened about 10 years ago. Is it still pouring radioactive water into the Pacific?
Yes, we have. It's one of our top trends for 2020, and we don't spell it Fukushima. We have a C and a U and a K in there to show you where it's really going on. And the reason it's going to get back in the news is because they have the 2020 Olympics in Japan. And some of those Olympics are going to be held in Fukushima. And there's already resistance, particularly coming out from South Korea, of letting their people go there because they're concerned about the dangers, the food, etc. So it's going to bring it back into the limelight, and there's very little research being done by governments. Most of it's being done by private people to show the dangers that continue to exist with this tragedy of Fukushima that have not been addressed.
Is the Japanese government cynically raising the allowable rate of or limit of radiation because of Fukushima?
Oh, all governments lie to do what they want to do. I mean, who would believe anything that they do? It's like asking the Food and Drug Administration to monitor the pharmaceutical industry when the people running the show are lobbyists that the revolving door keeps shifting into government and back and forth into the corporations. Now, the government agencies are nothing more than hacks for Big Corp.
Is society's addiction to smartphones causing mental and physical health issues?
All the data is there that shows it does, and it's being totally ignored, and it's going to get a lot worse with the 5G technology, where they're going to be putting antennas on light poles, telephone poles, rooftops, across the street, next to you, all around you. The radio frequency radiation is deadly. The facts are there. The studies are there. Just as I mentioned with the study that just came out about the lies about the Afghan war was in the news one day and out the next. The same thing with these studies. They barely make it into the media, and then they're covered up the next day. And people are addicted to it, so they can't kick the habit. Just like when I was a kid, my parents' generation, they were smoking like crazy. Remember those ads, more doctors smoke Camels than any other cigarette. So you get hooked to the addiction. And for people who call them smartphones, it's anathema to me.
Speaking of health, what's going on with Joe Biden's health?
I don't know personally, but again, look at the people that you have running that are leading the pack. There are very few young people out there. You got, Trump is going to be 74, 75. You got Biden, Sanders. I mean, General Dwight D. Eisenhower, 5-star general, Supreme Commander of the Allied Forces, who was selected. He didn't campaign. He wasn't a political party to run for office. And when he was in office, he was 70 years old. And he said, anyone over 70 years old should not be in this position. Because, of course, of the toll it takes on you and what you have to do to stay on top of this thing. Remember, this guy's a general, the Supreme Commander of the Allied Forces, and he said 70's too old. So, health? How about mental health?
What's your latest globalnomic view?
Well, the globalnomic view is what's going on around the world with all these protests that I've been talking about. And you tie that into the slowing global economy, and you have real problems coming up in the future. And that's why we're forecasting the greatest depression in 2021. We believe we're going to make it through next year, but the year after. Matter of fact, if Trump wins as we forecast, he'll become the Herbert Hoover of 2021 as the economy goes down. So that's what we're looking at. All of these protests, civil wars, unrest, demonstrations that are sweeping the globe. There's sending a message that people better wake up to, and the governments are completely oblivious to. So we're concerned very much about what's going to happen in the future.
What's the latest on Occupy Peace?
Well, it's a time for peace because they're going to take us to war. When all else fails, that's what they do. They take you to war. And you keep hearing the war drums beating louder and louder in the Middle East, particularly with Saudi Arabia, the United States, and Israel aiming at Iran, and how we're being taught more and more to hate the Russians, hate the Chinese. So we're not going to evolve as a society in many ways, and one of them that's very important business-wise is creativity. You're not very creative in a state of war and terror. So as long as this keeps on, the spiritual mood of the people, the world, and nations is going to continue to decline. Creativity will become a thing of the past. It'll stall as war talk keeps escalating, hate keeps building among different nations. So without peace, we can see the future, and the future will be what, when they asked Albert Einstein, how will the Third World War be fought? He said, I don't know. He said, but I do know the Fourth World War will be fought with sticks and stones. This is a very different time. All these airplanes, aircraft carriers, tanks, they're obsolete as bows and arrows. Their generals are always fighting the last war. This war will be a cyber war. It'll be a hypersonic war. It'll be a drone war. It'll be a chemical war. It'll be a war that will destroy the earth if the people don't stop it. And we have a lot of stupid people in government, psychos, egomaniacs, pathological liars, freaks and fools and cowards that are running countries, and they'll do anything to stay in power. Kill anybody, anywhere, any place. So if we don't occupy peace, we'll be occupying death in the very near future.
Gerald, how can people find out more about the Trends Journal?
Well, they could go to trendsjournal.com, and it's more than just a Trends Journal, which of course, it's a 50-page full-color magazine, both digital and hard copy. No advertisements, and we do Trends in the News broadcast each weekday night, Trends Weeklies, and Trends Monthlies. So it's the only place we know of where you could read history before it happens.
Gerald, thank you so much for chatting with us.
And thank you.
My guest has been Gerald Celente, publisher of the Trends Journal, online at trendsjournal.com. He was speaking to us from historic Kingston, New York. Coming up, Wolf Richter, next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf, and best of the season.
Thanks for having me, Jim.
Wolf, are automakers likely to make less vehicles for the 2020 and 2021 model years, and how could this affect the new auto market?
Well, the 2020 model year, started this year, and this year has not been a good year for the auto industry globally. In terms of the largest auto market, China, by far the largest auto market, 2019 will be the second year in a row of declines in auto sales. In India, one of the larger markets, auto sales and vehicle sales, really motorized vehicle sales, because there are some other vehicles that we probably, like three-wheelers and so forth. They have essentially just collapsed in the last few months because they have a financial crisis in the non-banking sector, and which funded a lot of these auto sales. So those have taken a very serious hit this year. In the United States, the peak year was 2016, and so now 2019 will be below that. 2016, the peak year was just at the level of the year 2000. So that's a very mature market. During the financial crisis, we had a huge collapse in auto sales and then a very long recovery, and then we hit that same level of around 17.3 million vehicles, and it bounced off again, So this is the level that we've seen 20 years ago, and now they're just sort of heading down. In Canada, auto sales also peaked in 2018, and they're now down. So automakers around the world are adjusting production to the new sales environment. And in North America, sales are declining by relatively smallish amounts. There's nothing collapsing here, but they're really seriously heading down in India and in China and in a couple of European countries. And so auto production will definitely decline, has already declined, and will definitely decline going into next year. In terms of U.S. production, we have another issue here, and that's now in part a trade issue. Even as auto sales in the United States have declined over the past 3 years, imports from Mexico have surged. And automakers are transferring more and more production to Mexico. It used to be they just built lower-end cars in Mexico. Now they've switched pickup trucks and SUVs to Mexico. General Motors, when it reintroduced its Blazer SUV, its compact SUV, it decided to build it in Mexico. So there are larger production declines going on in North America that would be justified by the sales decline because of the rising imports. And this is starting in 2016. U.S. manufacturers of Ford, GM, and Chrysler started shutting down plants and laying off people. They've essentially eliminated a whole bunch of car lines, all three manufacturers. Those plants have gotten shut down, and they've laid off those people. Have transferred some of them to the pickup plants, the SUV plants, which pickup SUVs are doing very well. They're increasing in sales, but car sales are declining so hard that SUV and pickup sales can't keep up, and that's the issue kind of around the globe. And so auto production will definitely be down, and this we have seen this in the manufacturing numbers. So the manufacturing numbers around the globe have been weak, and part of that is the auto industry, which is within the manufacturing sector. It's a very big weighs very heavily. Germany is heavily focused on the auto industry in terms of manufacturing, not just assembling cars, but also the components that they make and export all over the world. So their manufacturing sector has taken one of the hardest hits. Other United States is not so dependent on auto manufacturing in terms of its overall manufacturing, so it was smaller, but we could feel it here. And so this is a trend that will definitely continue in the calendar year 2020, and when the model year 2021 come along, so this will be mid-2020, production will likely also head down. I don't see any impetus there for auto sales to increase. They might hopefully flatten out at some point, especially in China and India where the declines are really serious. And in China, they're still building manufacturing capacity right now. So there's an overcapacity issue in China. They're building capacity as if there were no tomorrow. At the same time, sales are declining. And we know what that means in the auto industry. Once the capacity there is there, it gets very expensive, and there's going to be a major shakeout. And they have lots of locally owned companies, and so probably there's several hundred EV companies over there, make electric vehicles. And there's already a shakeout in that market. So we'll see that get pretty tough for automakers, I think, in China and in India. In the United States and in Canada, we'll also see that sort of drip decline that we've seen over the last 3 years. And production will continue to shift to Mexico as far as our market here is concerned. That's just written in the cards. Maybe the new trade deal will slow that down a little bit, but there has been systematic wage repression in Mexico between the unions and the automakers that set up shop there and the government, the local ones. And the new trade deal is supposed to address that and put in some teeth into it to deal with that, so that Mexican wages can rise, which they need to. They need to for Mexico's economy, and they need to because it's just too hard for U.S. workers to have to compete with, which is now one of the cheapest places in the world to manufacture cars. Auto wages and the automaker wages in Mexico are among the lowest in the world. China's wages have far outpaced wage increases in Mexico. So this has to be addressed. It's going to be addressed hopefully with the new trade agreement. But meanwhile, until that really becomes effective, I think we will see further production shifts to Mexico and further reductions in production in the United States and in Canada.
We'll have more with Wolf Richter right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, there are rumblings coming out of the consumer subprime lending sector in the U.S. What's going on there?
Yeah, that's interesting. We have a very strong labor market right now, relatively speaking. It's been crappy for so long that the labor market that we have now is considered historically strong, but there's a large number of potential workers that are still not participating in the labor force, so they could still be drawn out with higher wages and better working conditions. So it's not perfect, but it is very strong, relatively speaking. And there have been no major layoffs. Companies are still hiring. They're trying to find employees. So we've got this sort of dynamic in the labor market. At the same time, we now get more and more signals across the board from consumer subprime lenders showing big signs of trouble. And this comes from subprime credit cards, and it comes from subprime auto loans, and it comes from retailers that focus on subprime-rated consumers, where they're selling them couches and TVs and furniture and appliances, and they finance those sales in-house. And because these customers don't have credit cards and maybe they're maxed out and they're subprime customers, so they have trouble borrowing. And so these retailers finance those sales in-house with their own subprime loans, and they make a lot of money on those. And now we've had one of the larger ones report a major problem. This is Cons here in the United States, and they're worried about the leading indicators of that. So there are all of these subprime auto lenders and subprime consumer retail focused people. They're all saying, we have an issue with early payment default or first payment default. So people take out a loan and they miss the first payment, or they miss the second or third payment. And so this is a real big red flag. And they have an issue with delinquencies now cropping up really bad this quarter. And in the auto loan sector, that's been going on for a while, but now it's shifted into to the consumer sectors. With credit cards, it's been going on since 2017. So this is really getting impetus now. And now subprime does not mean poor or impoverished. It is based on a credit rating, a FICO score of below 620. So this could be people with pretty good incomes, but they've just gotten in over their heads, and they were late on some payments, and maybe they defaulted on some things, and so the credit rating drops, and they become subprime, even though maybe they have a household income of $100,000 a year, but they've got too much debt and they can't deal with it anymore. They missed some payments, and so now it's subprime. So subprime is not poverty; it is a credit rating, and it's like junk-rated bonds in the corporate sector. These companies are not necessarily poor; they just have a low credit rating. And in the subprime sector for consumers are these people that have already defaulted on some of their prior loans, and they're late on some other things. And so they're high-risk borrowers as industry is concerned. And so they're being charged very large interest rates, and we're talking about 20, 25, 30% sometimes. And when you give a struggling consumer, an already struggling consumer, a loan with an interest rate of 25 or 30%, you're almost guaranteeing that the consumer will default. You can't pay 25 to 30% on a loan if you already can't make your credit card payment. So this is sort of a self-propagating thing, and at the same time, these companies want to sell the product, and they've run out of prime customers to sell them to, and they want to sell them to subprime customers, and they want to also make money on the financing, and you can make a lot of money on subprime until they default. And so there's some element of greed going into this, and an early signs that these both the finance companies and the retailers have pushed too far to get these prime-rated customers to buy the merchandise to finance it. And this is a very serious problem. Now we have 1/5 of all subprime-rated auto loans in a state of serious delinquency. 1/5. That's 20%, or a little over 20%. And that's a stunning amount in terms of not in terms of the overall banking system. The individual banks may take a loss, but the dollars involved are not big enough to topple the banking system like subprime mortgages did. But it shows that they will eventually have to tighten this up. They will lose some money. They'll have to tighten this up. They will have to start funding some of these customers. And this is what we have seen in the retailer when they reported the other day. They ran into these early red flags this quarter. So they had surging first payment defaults, and they had 60-day delinquencies jump on them. And so they decided to tighten their credit standards. As a result of the tightening of the credit standards, their same-store sales dropped 8% when they'd been rising before. So this is what that does. When you're trying to tighten up your credit after being out there lending in the loosey-goosey manner, now your sales are going to get hit. The auto sector has already seen that. Some of the declines in new vehicle sales in the United States are from the fact that some of the subprime lenders have tightened their credit, and some of the subprime market customers can no longer buy a new vehicle. So now they have to buy a cheap used car, where they can get a loan for it. And so you see this ripple through when you have aggressive funding for subprime rated, consumers, you can increase your sales. But when the defaults hit and you gotta deal with it, and you're starting to lose money on subprime, and you're tightening up your credit standards to prevent further deterioration, suddenly when your sales go down. And I think that's what we're seeing right now. When we have financial crisis type default rates in some sectors of the subprime market, especially in auto sales, and they're fairly high in credit cards now too. And, but at the same time, we have a very strong labor market. So it's not that these people default on the loans because they've been laid off. That's not happening. They have jobs and they're defaulting on their loans. So this is something that's happening in good times. When we get the next downturn, and already, the delinquencies are high, so during the next downturn when consumers are losing massively, when they're losing their jobs in large numbers, you will see a historic spike in defaults on subprime rated loans, and then probably prime rated loans too, because prime rated consumers become subprime during a downturn, have to lose their jobs and they can't make the payments, and they'll fall behind on their mortgage and their credit cards, and then they'll end up with a credit score that's prime. And that's what we've seen. So when we get a downturn, we will see this become a real problem in terms like we've never seen before. We've already got a real problem, and these are the good times. So, this is something I'm worried about because, you're not supposed to have subprime blow up like we're having when the labor market is so strong. And normally that's an issue that's caused by a labor problem. And that's not the case now. So it's caused by another problem. And when we do get that labor problem, when the labor market declines and some of these people lose their jobs, we'll see horrendous default rates on those loans.
The Federal Reserve, central banks, and some global institutions such as the IMF now publish so-called financial stability reports once or twice a year. What's on top of their worry list?
The Fed just came out with its in November with its financial stability report. So did the ECB, and the individual banks in Europe are doing the same things. The Bundesbank in Germany, and some of the others, they're not in the Eurozone, and they're all saying the same thing. And it's really amazing. They're saying low interest rates have caused corporate and business borrowings to skyrocket to historic proportions, not only in monetary terms, but also as a percent of GDP. And they're seeing this. And they're worried about it. So this is their number one concern, and the Fed has pointed that out many times, and the ECB has been pointing this out now too. The Bundesbank has come out with it. they're worried about corporate debt. And corporate debt includes business debt, actually, the mom and pop restaurants and the corporate entities, and also commercial real estate, which has been fingered by the Fed as in bubble territory for a couple of years now. And these are all heavily leveraged sectors together. So business debt, commercial real estate debt are $18 trillion in the United States. So that's a very large amount. It's larger than residential mortgages. So there's a problem. Residential mortgages in the United States are about $11 trillion. So there's a problem with these business and corporate debts and commercial real estate. It will have a bigger impact than the mortgage crisis did during the financial crisis. The mortgage crisis brought down the global financial system. So these are things that they're now really worried about. Now, businesses are different from consumers in that they have a lot of leeway. When a consumer loses his or her job, the revenues go to zero. A business doesn't really do that. The revenues don't really go to zero. They decline. They decline by 5% or 10% or 20%, but they don't suddenly go to zero as a household's revenues go when they get laid off. So it doesn't quite happen as suddenly in the business sector, and businesses are not as leveraged as households were, and they can lay off people and they can cut expenses and they can do some things that households can't do, and that's exactly what they usually do. And so that's what central banks are pointing out. If there's a problem in the business sector and they start to have bond defaults and loan defaults in the business sector, you will get layoffs and you will get cutbacks in spending. And that's how a problem in the business debt market translates into the real economy. These businesses will cut back. They'll try to minimize their cash outflows, and so they stop spending and they're laying people off, and they're trying to avert default. And if they default and they go through a bankruptcy, a restructuring of some sort, that will entail further asset sales. They will entail further layoffs, and expenses will be cut. And so the business come out of that process with less debt and more able to move on. But in that process, during that process, you will see layoffs and cutbacks in spending, and that will hit the real economy hard. And then you'll have the consumers reacting to being laid off. So they're defaulting on their obligation. So this is a problem that ripples through the real economy fairly quickly. And before it becomes a banking problem, it becomes a real economy problem. Any business that gets in trouble, the first thing they'll do is they cut expenses. And if that happens on a large enough a scale, it causes a recession, very quickly. And it can do a lot more damage if it goes on. So this is and that's what they're pointing out. They're saying, yeah, we've got this problem. We've got businesses that borrow too much. We're really worried about it. The central banks are worried about the banking system, but they're also worried about the real economy when businesses react to this debt situation, by cutting expenses and laying people off. And, so the solution would have been to not lower rates as far as they did, and the solution would have been to raise rates a lot sooner than they did. The Fed has raised rates a few times. It's now backed off some. The ECB hasn't raised rates. They've cut rates, and other central banks have done the same thing. So they're on the one side of the mouth are saying, look, we're worried about these low interest rates. They're causing this debt trouble in the business sector. They're causing all these kinds of issues in the commercial real estate. We're really worried about that. And then on the other side of the mouth, they're cutting interest rates further. And this is the scenario we're looking at right now. And it's like, okay, either it's just double talk and they're trying to do a little CYA and to say afterwards, look, we told you so. You shouldn't have borrowed so much. Now look at the mess you've created. Or they're preparing the world for rising interest rates. Now, something has to get done. You can't move forward with a debt bubble like this and assume that it somehow gets resolved on its own. Something will solve it. And it could be a wave of default. It could be a huge bout of inflation. It could be all kinds of other things. But none of them are going to be easy. They're all painful, and one may be worse than the other. But a debt bubble like this that we're having, and it's being pointed out by these central banks, we'll find a solution of some sort, and the solution is not going to be easy. And so the central banks are struggling with how to do this and how to do it slowly without blowing everything up at the same time. And my impression is they're trying to keep the plate spinning. At the same time, they're really worried about it. And my gut feeling is they're saying, look, this can't go on. We can't make it worse. We're going to have to, we're going to have to back off with our easing. We're going to have to start, normalizing our policies eventually. And we've seen a little bit of that. The Fed's tried to do that and taken some steps back. Now it looks like it's not going to take any more steps back. It's going to just stay pat for a while. The Central Bank of Sweden might be the first central bank in world history to move out of negative interest rates back into the zero or positive territory at its next meeting. The ECB has new leadership, and they're doing a policy review, so we don't know what's coming out of that, but it's probably also a sign that they're leery of the damage they're causing with their negative interest rates. And the Bank of Canada has the pat, and you've every central bank is looking at this issue of corporate debt now. It's all over in China. China's corporate debt is blowing up before our very eyes. That's got a problem over there, and they're bailing out companies, and they're bailing out banks, and they're really busy trying to deal with this. And of course, in China, you have the central bank and the biggest banks. They're all state-owned, so they have a lot of leeway, and a lot of the biggest companies are state-owned. So, that they're handling this via the government, but this is happening right now before our eyes. So, and I think the central banks have justified in worrying about this. They should have worried about it a lot sooner. They should have raised rates a lot sooner. They should have never let it get this far. But now that it has gotten this far, the question is, what do you do without blowing everything up? And slowly, that word slowly is probably the ticket. If the economy can adjust if you do it slowly enough, but if something happens quickly, it could get pretty rough. And corporate debt is just so big, and it impacts so many things, and business debts too, and it impacts everything from households to government and government revenues, everything, and so it is something very serious that goes wrong, and I think they're putting it on the table, and they're saying, look, we've got a problem, and they're saying it to their credit.
Wolf, thank you so much for chatting with us, and best of the season.
Thank you, Tim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Gerald Celente, and Wolf Richter, and thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese CEO Larry Reaugh and Cypress Development's Don Mosher. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim. I'm happy to be here after last week.
Yeah, a little bit of a medical thing, but I'm glad to see and hear that you're all okay now.
Yeah, that's something I wouldn't wish on anybody. It was a totally debilitating bug. You lost all your strength, legs, arms, everything. And you had to be helped up. You had to be, geez, I thought I'd aged about 100 years. But anyway, that's behind me, I'm hoping, and, I'm feeling a little stronger every day and ready to go.
Larry, another news release from American Manganese this week. What was in it?
Well, we're finally getting started on the Department of Energy samples that we received last year. No, not last year, a few months ago. And but we decided that Tier 1, trying to get those guys interested and get continuing interest from them, that we should move on the Tier 1 samples. So we had to put them on the back shelf, but now we're working on them, and we're working with material that we didn't prepare, but which we can prepare some of it, and so it'll move through. I don't expect to have results until probably the very end of this year or early next year. So, but you never know. I've been surprised before, so let's hope that we get those. Now, there's a lot of information out there about other companies that are going to be recycling batteries, and they want to have a green solution and everything else. And I just want to remind our readers, because I keep getting poked on this, is where do they stand with us? Well, first off, again, I've explained this before. We can't find any patents, and we can't find any description of the work that they're doing. Just kind of round numbers thrown out, and so we can't comment on that. We don't know exactly what they're doing, and but we've been transparent. Everybody gets our results, and it's been risky when we were first filing our patents. But we felt that transparency was really important, and that will probably become a more important aspect of our solution coming down the road. And everything is arm's length. We don't. Chemetco doesn't own a share or anything in the company or anything in the patents. And so everything they do is totally arm's length. They're not going to jeopardize a company that's as progressive as theirs by putting out results that don't meet mustard and can't be backed up. So I just want people to remember that the most important step that was ever taken was the development of our metallurgical process, and the 2 patents that have been granted, and a third one that will probably be applied for early next year. And, so that gave us the jump start on other companies. Certainly if they'd have looked at the patent that we had on manganese, they would have had some idea of where we were going. So, like I say, it was a chance that we were willing to take, but most people, when they look at a metallurgical solution, they look at various different methods of doing it, some of it which gets the cathode materials, maybe not good recoveries, maybe not high purity, but other methods of reagents that we're very happy with what we got, because we can show that we've got a closed loop solution, and so we're going to be moving ahead on that. Now, the company is going to be spending next Monday. We will be closed half a day because we'll be going down to the Chemetco party. And I just want to mention that that I have some pressing personal issues that required me to sell some stock, along with my usual requirement of selling some stock out of my RSP. And so you'll be seeing that coming out here shortly on probably the billboards or wherever, reporting insider selling, but, it doesn't amount to a hill of beans when you think that we've traded over 500 million shares in 2.5 years or 3.5 years. For me to participate in that small amount is certainly not earth-shaking. Doesn't mean I'm abandoning the project. Doesn't mean that that I have no more faith in it, because I do. Because one thing that doesn't keep me awake is that we are ahead of the herd, and we want to remain there. So I just thought I'd mention these couple of things going forward here, because we're going to anything that's bad news will show up on the BBs, and they're considered to be bad news, or to put a slant on it that it's bad news, will definitely come on the BBs. And so other than that, I'm not sure exactly how we'll handle the podcast going forward, because there's going to be people away on holidays and everything else. We got to get distribution on that. But we're going to try to keep our podcast up as a weekly podcast, regardless of the holidays. So just to let people know that, we will be working throughout the holidays. We're getting, people are concerned about the stock that hasn't moved up, but they got to remember there's two things happening. One is we've always got the predator trading, actually three things. The other is that there is a warrant exercise going on, and we've gotten a few $100,000 in from that already. And, most of the people will, some of them will be selling stock in order to exercise their warrant. And, so that's always putting pressure on it. And of course, the usual pressure that comes with, tax loss selling. And, but we're working our way through that. The stock is, resilient here at the 20 to 22 cent range. And, so I couldn't be happier with the way things are going. And I wish everybody, if they're heading out for a long holiday, I wish them all a happy holiday, and certainly a Merry Christmas and a Happy New Year.
Larry, for people wanting to know where you're traded and how to get more information, what's the answers to those questions? Well,
we're trading on the Venture Exchange, the Toronto Venture Exchange, under the symbol AMY. We're trading in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. They can go to our website at AmericanManganeseInc.com and do their own due diligence on the company. They can email me at LREAUGH@AMYMN.com, or they can phone at 778-574-4444.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on December 13th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of Howe Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
My guest is Don Mosher, corporate consultant for Cypress Development. Welcome back to the show, Don.
My pleasure, Jim. How are you doing?
I'm doing great. How are things going around the Cypress Development office, plans for the holidays for the company?
Everybody's getting ready for Christmas. We're waiting to get the results on our pre-feasibility study sometime in January. And there really isn't a lot for anybody to do in the meantime. It's all in the lab, where basically you're taking a bench version of a pilot project and taking solution that you've run through filtration and now taking the solution and trying to take it to a point where you can produce lithium grade or battery grade lithium hydroxide with electrolysis. So it's a multi-step process. You're starting out with clay, you're leaching the lithium out of it, you're removing the solids, your process runs it all the way down to a point where we're ending up with an end product, not something solid, but a solution that then can be dealt with and sold. And you know, what we're happy about is our jurisdiction as much as anything else. We're seeing all kinds of problems with lithium production around the world, specifically the brines up in the Atacama Desert. And it's a baffling market to some regards right now. It's not traded globally the way large commodities like copper are. It's more of a contract basis. And listening to different experts out there, they can't figure out why the prices are down 12% and the demand's up 18%.
Don, I think in our previous interview, you mentioned, though, that lithium comes in so many different grades and the price you get depends on the grade and its ultimate destination.
Yeah, and I mean, when I talk battery grade, I'm not dealing with specific specifications that different battery manufacturers are requesting for their specific product. So, I mean, we can talk battery grade, but at the end of the day, what are the specs on that battery grade lithium? You know, the U.S. has fallen behind, but they appear to be trying to catch up. When I talked to you last week, I knew of 5 U.S. battery plants that were in the pipeline. And then on Friday last week, GM announced a deal with LG, and they're going to build a $2.3 billion plant in Ohio. So that just added a number 6 plant to that. You're looking at a country with virtually no lithium production. I mean, the only production in the country is from a small facility in Clayton Valley where we're located. That's, 3,500 tons a year into a market that's 320,000 tons of demand and is projected to grow to 800 to 1 million tons by 2025. With the growth we're seeing at 18% and the fall in prices by 12%, it's putting a lot of projects on care and maintenance because the economics don't make sense anymore. And I think it's a particular market that can be manipulated, whether it's by the Chinese or whoever manipulating it, to try and get the lithium at the best prices they can on a contract basis, because nobody out there is trading it globally. And if I had a druthers, I would want to be in Clayton Valley, Nevada, in the U.S. of A., putting forward one of the largest lithium production scenarios out there at very reasonable costs, offering a domestic supply of lithium to at least these 6 mega factories that are in the pipeline. Because where are they going to get their lithium if we come up with shortages? There's experts out there saying that we are going to have a lithium shortage. They will not be able to keep up with demand by 2021. And we'll only be through half the permitting process at that point in time. But I think with our pre-feasibility study, it's going to put the project, if not the company, into play. Somebody's going to want to own it. Somebody much bigger than Cypress that probably is already a global producer.
Is it encouraging for Cypress and the development of lithium to see an expanding market for batteries? We just saw Harbor Air in Vancouver that runs float planes on short hauls, 15 to 30 minutes, which is, I guess, perfect for a battery-powered aircraft. And although it's a very tiny market and just experimental right now, does that give an eye to the future of what's going to happen with batteries?
Yeah, absolutely. I mean, they're working diligently to try and increase the energy storage capacity of batteries. That's always been the problem with electric. To be able to store and transport airplanes, cars, trucks, I don't care what it is, but can you actually store enough energy to get that particular vehicle from point A to point B and carry the required load? And in the past, it's always been the size of batteries and the real lack of energy storage compared to gasoline or diesel fuel or anything along those lines. So we're going to see more advancements coming in. We're going to see more expansion. I mean, I believe the Tesla plant is 30 gigawatts right now in Nevada, and they're looking to expand it to 70 and maybe bigger. So even though I'm talking, okay, now there's 6 megafactories in the pipeline, don't forget that one's going to continue to grow in size to supply Tesla with the Panasonic batteries that they happen to be using in their cars. I can't see anything but increased demand around the world. And I just don't know where the lithium supply is going to come from, because the brines, I can't see producing a lot more lithium. I don't see how they're going to expand them with the water problems that they have up there. And obviously, if you're pumping a brine, you're having an impact on the aquifers, and the locals are all using that same water for agriculture and their own household needs.
For people new to Cypress development, what are you all about?
We are a development company developing a lithium resource that'll hopefully also produce some rare earths. We trade on the Toronto Venture Exchange under the symbol CYP. We trade down in the United States on the OTC under the symbol CYP.V, and in Frankfurt under the symbol C1Z1. All our information is available online at CypressDevelopmentCorp.com. And right now, we're trading in around 18 cents, although we're developing a project that's got a net present value of $1.43 billion US based on our preliminary economic assessment that we put out earlier in the year.
Don, thanks a lot for the update.
My pleasure.
My guest has been Don Mosher, corporate consultant for Cypress Development. I'm Jim Goddard. Our conversation took place on December 11th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.